Hey everyone, welcome to the channel. Have you ever heard the term asset allocation in the world of investing? If you're just starting your investment journey, this concept might sound complex, but trust me, it's one of the most important strategies for managing risk and growing your wealth. In today's video, we'll be diving into what asset allocation is, why it's so essential for your investment strategy, and how you can use it to reduce risk while building a solid investment portfolio. So, if you want to learn how to make smarter investment decisions and protect your wealth in any market condition, keep watching until the end. What is asset allocation? Asset allocation is essentially how you divide your investments among different asset classes, such as stocks, bonds, real estate, and commodities like gold. The goal is simple: to balance risk and reward by investing in a variety of assets that don't all move in the same direction at the same time. Think of it like this. You've probably heard the saying, "Don't put all your eggs in one basket." That's exactly what asset allocation is about. If you put all your money in one type of investment, such as stocks, and the stock market crashes, you're in big trouble. But by spreading your investments across different asset classes, you reduce the risk of a total loss. Why is asset allocation important? So, why is asset allocation so important? Well, simply put, markets are unpredictable. Stock prices can go up and down rapidly. Bonds might be stable, but they're not immune to inflation. Gold might hold its value over time, but it doesn't necessarily generate income. By spreading your investments across a variety of asset classes, you ensure that if one investment performs poorly, others can help cushion the blow. For example, during a stock market downturn, bonds or real estate investments may remain stable, helping balance your portfolio's overall performance. How asset allocation impacts your wealth. Let's take a real-world example. Imagine you're a few years away from retirement. You might want to avoid taking on too much risk, so you would allocate a larger portion of your portfolio to more stable assets, such as bonds or even gold. A simple portfolio for someone in this situation could look like 60% bonds, 30% stocks, and 10% gold. On the flip side, let's say you're younger and have a higher risk tolerance. You might allocate 80% of your portfolio to stocks, with only 10% in bonds and 10% in gold. Over time, this portfolio has the potential for higher returns, but it also comes with more risk due to the high percentage of stocks. The point here is that asset allocation allows you to tailor your investment strategy based on your individual risk tolerance and financial goals. How to do asset allocation. So, how do you actually implement asset allocation? The first step is to assess your risk tolerance. How much market volatility can you stomach? If the thought of a 10% drop in the stock market makes you anxious, you may want to lean towards more conservative asset allocation. But if you're comfortable with market fluctuations and looking for higher long-term returns, then it's okay to take on more risk by allocating more to growth assets like stocks or real estate. Once you know your risk profile, it's time to diversify. A common strategy is to invest in a mix of assets, like stocks for growth, bonds for stability, and gold for a hedge against inflation. You could also consider real estate, which has the potential for both income and long-term appreciation. Remember, the key is diversification. Don't rely too heavily on one asset class. Keep in mind that your asset allocation should evolve over time as your financial situation and goals change. As you get closer to retirement, for example, you might shift more of your assets into bonds and other low-risk investments. So, to sum it all up, asset allocation is an essential strategy for managing risk and achieving stable returns. By diversifying your investments across different asset classes, you can protect yourself from market volatility and ensure steady growth over the long term. If you found this video helpful, please hit the like button and subscribe to the channel. Also, let me know in the comments what you think about asset allocation, or if you have any questions. I'd love to hear your thoughts and continue the conversation. Don't forget to share this video with anyone who might find it useful, and I'll see you in the next one.